Good morning, ladies and gentlemen. We're here this morning to discuss the issue of tax reform and have two tax experts, if you will, with me this morning. I'm John Barry, of the Washington Post. On my right is Joseph Pechman, who is a senior fellow at the Brookings Institution in Washington and formerly was director of the Economic Studies program at Brookings. On my left is John Makin, who is Director of Fiscal Policy Studies at the American Enterprise Institute in Washington and a professor of economics on leave from the University of Washington. In recent months, there has been a great deal of discussion about tax reform, about tax simplification. Politically, it has become a hot issue here in the Capitol and around the country. From the Democratic side, we have a so-called fair tax proposal from Senator Bradley of New Jersey and Representative Gephardt of Missouri. From the Republican side, we have the FAST tax, the fair and simple tax, from Representative Kemp of New York and Senator Casten of Wisconsin. And just before the end of the year, the Treasury of the United States weighed in with its report and proposals for change called Tax Reform for Fairness, Simplicity, and Economic Growth. It was a very sweeping set of proposals for change. And in its introduction, the suggestion is made that change is required because, as the Secretary of Treasury, Donald Regan, said at that time in his letter transmitting it to the President, the present U.S. income tax is complex, it is inequitable, and it interferes with economic choices of households and business. It is also widely perceived to be unfair. Because this perception undermines taxpayer morale, it may be as important as the actual defects of the system. Mr. Pechman, is Secretary of Treasury Don Regan right? Is the system unfair? Is it too complex?
Yes, I think that he is right in all those respects that you read. The basic unfairness of the system is that people with different incomes and businesses with people with the same incomes and businesses with the same incomes will pay different taxes. And this is the result of the fact that we have proliferated a great many deductions and exclusions and preferences in the tax law. I think the average taxpayer feels this by looking at a tax return which is horribly complicated and which he himself doesn't understand and has to get advice to fill out his tax return form and even go to H&R Block and other tax preparing firms to help him fill out his tax return, and he has to pay for it. Most people don't benefit from the major loopholes of the tax law. Yet they're very angry about it because they feel that somebody else is getting away with murder, and they're right. The purpose of any one of the plans that you mentioned is to equalize the tax burden on people with the same incomes and businesses with the same incomes. In doing that, it will simplify the tax law, and at the same time will remove a great many distortions in our economic system. The tax system does generate behavioral responses. The whole tax shelter industry that it spawned can be seen by walking down any downtown street in our major cities. Most of those buildings, and most of them I don't particularly care for the architecture either, most of those buildings were built with tax shelters. And the capital that was used for those buildings could have been used for industrial and more productive investment. In brief, I think that there's a lot wrong with the tax system. The tax system needs to be cleaned up, and I think that equity and economic efficiency would be better served if it were cleaned up.
Mr. Makin, let's focus on the Treasury proposal, because that's the one that is the most comprehensive, I think, of the three, and one that the administration will be putting forward in some version officially before long. What is the essence of the Treasury tax proposal? How is it going to address the issues that Mr. Pechman raises, the questions of fairness and complexity?
I think the essence of the Treasury proposal is to move toward a tax system where, as Joe says, people with the same incomes pay about the same tax. Another way to look at that is to say that for a household or for a corporation, the tax code that the Treasury is seeking would be one where a decision is essentially made on economic grounds, or whatever grounds a household might want to make it on, not on tax grounds. For corporations, CEOs would spend less time with their tax people and their tax specialists. Individuals wouldn't, every time they wanted to decide, should we invest in this or should we buy that, wouldn't be asking what's the tax angle. They basically would be looking at it on its own merit. That's essentially an operational definition of a neutral tax system. So I think that the Treasury proposal is aiming at a neutral tax system where the tax base is income.
Well, can you be more specific? What, for instance, would change as far as individuals are concerned? I know there is a proposal that they would lower tax rates. How do they lower tax rates and still raise the revenue that they need?
Well, there, of course, you have the base broadening provisions. In other words, the Treasury proposal suggests that households fall into one of three brackets, 15, 25, 35, which is, of course, lower than the current rate structure. They make up the revenue by taxing a number of things that are now not taxed, such as deductions for state and local taxes, deductions for some health care benefits, and so on. So you have to broaden the base while lowering the rate structure. The idea being, with a lower rate structure, is to make it more attractive to put out that extra effort to earn that extra dollar, because the government's going to take less of it away.
Okay. Mr. Pechman, the President, when he asked the Treasury originally to do the study that led to this proposal, said that it had to be revenue neutral, that whatever the changes that were proposed, in total, they weren't supposed to raise more revenue than the present system is going to raise. Was that a wise approach? Should it be constrained to be revenue neutral? And secondly, should that principle be applied, if at all, one step further, so that businesses would pay the same tax they pay now in total, and individuals pay the same tax?
Well, the revenue neutrality that the Treasury proposal has is that the total tax take from individuals and corporations is the same, or would be the same, if all of the proposals were adopted intact. It is not revenue neutral as between the individual income tax and the corporation income tax. In fact, the average tax burden of corporations would rise something like 25%, and the revenue so gained would be used to reduce the average tax burdens of individuals by roughly 8%. Now, you could devise a system where the businesses would pay the same tax, and individual as they do today, and individuals would pay the same tax as they do today. But the Treasury plan has one feature that appeals to me that would be difficult to do if you adopted it and had revenue neutrality only within each tax, and that is it increases the personal exemptions. I think it doubles the personal exemptions. That is rather expensive, and if you would do that without getting some revenue from the corporation tax, the rates would have to be higher. More importantly, I think it should be observed, as the President himself said in a press conference recently, the increase in tax burdens at the corporate level would not apply to corporations who now pay taxes. It would apply to corporations which, because of tax shelters and other provisions in the tax law, do not pay any tax or pay very little tax. And I think that's a fair way of doing it. Let us get the businesses that are getting away with murder to pay at least a larger share of the tax burden than they do today, and use the money to reduce individual income tax rates and to increase personal exemptions.
Two specific proposals in the Treasury plan are to eliminate the 10% investment tax credit, a credit businesses get when they buy new equipment for their plants. Second would be to make some very major changes to reduce the speed with which they are able, for tax purposes, to write off new investments. In 1981, in the major tax bill that year, businesses were allowed in the future to write off investments in plant and equipment very rapidly, much more rapidly. For instance, in structures, I think the time was lowered from 40 to 15 years. A number of people, a number of industries have criticized the Treasury plan for wanting to move back in the direction of longer periods of depreciation, a longer period over which they have to recover that investment. And others have simply complained about what Mr. Pechman is saying, that they're going to pay more tax. They never say it's unfair to them, but they argue that it would decrease investment and therefore, over the longer term, decrease economic growth. Is that a fair criticism, Mr. Makin?
Well, let me start by saying I don't know the answer to that question yet, and I would add neither does anybody else. To be perfectly honest, I think to really answer that question, you have to calculate the effect of a very complex set of provisions in the Treasury proposal on effective marginal tax rates on capital income, that is, the extra tax you would pay on a new investment. But certainly, let me go back and then talk a little bit about the investment tax credit.
That's extra tax you would pay on the income.
On the income from a new investment. So you're looking out ahead and you're calculating, okay, how much more tax am I going to have to pay on an additional dollar put into a capital project? And again, the answer to that question is very hard to calculate. One of my colleagues, Don Fullerton, is working on that, and we hope to have some results soon. But right now, we don't know, notwithstanding all of the discussion that's been in the paper and the rather, I think, careless discussion in some quarters that the Treasury plan is going to hurt capital formation or it's going to help capital formation. I think part of that confusion comes from the assumption that if you increase the tax you collect at the corporate level, that's got something to do with investment. And as a matter of fact, it has very little to do with investment. You could collect no tax at the corporate level. You could impute all of corporate earnings to individuals and collect them all at the individual level. Or you could collect more tax at the corporate level and have a lower effective marginal tax rate on capital income. So I think we have to be careful to distinguish between the effects of a tax plan on investment and how much tax is being collected from corporations.
May I just add something to what John just said? I think that the complaints that the public is hearing and that you see almost daily in the business section of newspapers are coming from the business enterprises that benefit from tax preferences and loopholes in the present law. And you'd expect that. Clearly, if you eliminate the tax shelters for real estate, that the cost of capital of building commercial buildings would rise. And the people who are in that particular activity would feel they're being hurt. And probably that is the case. The question is, when you take all of the provisions together, counting not only the people who are hurt, but also the businesses and individuals who benefit from rate cuts, what is the net impact on economic growth? John is perfectly right that the economists can't tell you precisely what the whole gamut of provisions would amount to in terms of economic growth. My own personal judgment is that the net effect will be beneficial to the economy. I don't think it'll be very large, but I think it'll be beneficial. In other words, that the rate of growth will increase modestly if all of the provisions of the Treasury plan were adopted. Now, that's a big if, because there are already proposals on foot to eliminate some of the base broadening proposals. And to the extent that you do that, you retain the distortions that you have in the tax system and lose the benefit of neutrality, which is so important, I think, from an economic standpoint.
Well, let me be clear here. If it is so hard to know what the effect of these changes on economic growth would be, is it necessarily clear that there is something here that needs to be changed? Why is it that it's so hard to know that this would be a good thing to do?
Well, the reason it's hard is that you know the direction of the effect. That is, you know, for example, that highly leveraged commercial buildings, that is, buildings that are financed primarily out of by debt, that such building would lose most, if not all, of the tax advantages that they have under present law. You know that if that's the case, that there will be less building of that kind of structure. Now, the money would either be consumed or invested. One has to assume that savers would not, because of that provision, reduce their saving, and so that the saving would go elsewhere, probably to industrial enterprise. And the question whether the capital used in other enterprises would be more or less efficient and would generate more productivity growth is a difficult one for economists. But on the whole, I think that the direction of the effect is known. That if you increase the incentive to invest in computers and industrial equipment and so on, you're likely to increase the efficiency of labor and therefore economic growth. But I think that the fact that we don't know precisely what the magnitude of the effect is, I think we do know the direction.
Let me try to amplify on what Joe's saying a bit. I think that there are really two dimensions in which it's important to try to judge any tax plan. One is how much bang from the buck do you get from a dollar's worth of investment, and then the other is how much investment do you get. Now, there may be a semantic difference. When I think of growth here, I think of the overall level of investment. That's where I have some question mark. But I have no question that the Treasury proposal would essentially allocate capital better among industries by taking away some very strong incentives, in fact, subsidies in some areas, and causing that capital, which is earning a fairly low return, to move to industries that haven't had preferences where the return is higher. So in terms of, I would call that the resource allocation effect, I think there's very little question that the Treasury plan has some considerable resource allocation gains in it. As to what it would do to the overall level of capital formation, that's where I have the question. But the resource allocation gains are, I think, not well understood. I think fairness in the title here of the Treasury tax reform proposal, I think that's meant to be a PR word for what economists call neutrality, and the idea of neutrality is probably the most significant part of the Treasury plan. It's come back to what I said earlier. Fairness, and this is just an aside, but who wants an unfair tax system? I don't think it's a very useful word to talk about a fair tax system. The word fair is very value loaded and isn't going to be a useful guide to fundamental tax reform.
In responding to an earlier question, you suggested that we might be just as well off if we weren't collecting tax at the corporate level at all, that maybe we should collect the tax from individuals instead. Why doesn't it matter if a business enterprise pays a tax? Would you simply tax the people who own the business? How would you go about that? And might that be a reform, a change that would be preferable to trying to make the specific alteration in the present system that the Treasury proposes?
Well, I don't want to get too far into this pretty technical area, but basically what you could do is who owns corporations? Shareholders. So you would impute the undistributed profits of the corporation to the shareholders, or you count the dividends in their taxable income and you tax that. The Treasury proposal does address this issue a bit, when they try to do away with, say, double taxation of dividends, what they allow the corporation to do is to deduct the dividends that they pay to individuals and then have the individuals pay the tax on the dividends. You could go further and, again, if you went all the way in reducing corporate tax liabilities, you would have corporations paying no tax, and if the corporations tried to get clever and then not distribute any dividends, you would simply impute the value of retained earnings to the shareholders of the corporation, and that would be included in their tax base.
May I add something on that question? It is true that individuals pay tax and ultimately pay the tax of corporations as well as their own businesses. The question of whether you want to eliminate the tax at the business level depends upon what kind of tax system you have. We have a tax system which relies very heavily on the individual income tax. If you did not tax income at the corporate level, you would simply generate a huge tax avoidance mechanism. People would simply accumulate income in corporations, and corporations would not pay dividends. People would get wealthy without paying tax because retained earnings would continue to earn income continuously. The present tax system is sort of a compromise between the idea of avoiding too much double taxation and at the same time making sure that there's not any tax avoidance. What the Treasury plan does is go halfway. It recommends that businesses be allowed a deduction for half the dividends they pay. If they didn't do that, they could reduce the tax rates even more than they did. As you know, the Treasury plan proposes a reduction of the general corporation tax rate from 46 to 33%. If they didn't have the dividend provision, they could reduce the tax rate to 30%. That is a measure of also moderating the double taxation of dividends. Finally, I think it ought to be noted that the impact of the corporate tax is, unlike what many people say, is highly progressive. I believe, and I think most economists believe, that the corporate tax is paid by the shareholders, by the people who own the corporation, not by consumers. And therefore, and since most shareholders and most shareholdings are concentrated in the top brackets, the corporate tax obviously imparts a degree of progressivity to the tax system that it wouldn't ordinarily have. Even so, my latest calculations suggest that the average tax burden in the top, say, 10% of the income distribution is not much higher than the average tax burden in the middle or lower income classes, even after taking into account the so-called double taxation of dividends. So I would be very careful to avoid making the income tax even less progressive than it is today, and it's only moderately progressive. I would be careful before eliminating or before adopting a full dividend relief provision.
What do you think about that? Do you think that the corporate tax indeed adds to the total progressivity of the system? And if it does, is that a good idea? There are a number of people around who argue that a flat tax in which everyone basically pays at the same rate is a superior approach.
Well, I think a large source of the progressivity of the corporate tax is, of course, under the current system, is that both capital gains and dividends the dividends are taxed twice, and nominal capital gains are taxed. A very typical experience that some investigations of the experience of shareholders in the 1970s found was that share prices doubled in nominal terms, stayed constant in real terms, and the shareholders, in a sense, paid tax on illusory capital gains. a $1,000 share in 1970 became a $2,000 share in 1980. It had no additional purchasing power, but if you sold it, you paid whatever tax was due on a $1,000 capital gain. So I'm not at all surprised that Joe suggests that there is a degree of progressivity in the implicit in the corporate income tax, given that higher income individuals are more likely to own common shares. I think when you turn it around and look at it from the corporation standpoint, the way the tax system treats dividend expense, it's not deductible, versus interest expense, which is fully deductible. The big mystery for economists is why any corporations issue common shares. Why don't they all use debt financing where the interest payments are fully deductible? I think part of it is, of course, due to the additional flexibility that equity financing or issuing of shares does for you relative to debt financing.
One thing that John said needs amplification, I think. The Treasury proposal would adjust the tax base for the effect of inflation. And in the case of capital gains, as John pointed out, what it would do would be to eliminate the inflation component of capital gains. In other words, it would only tax real capital gains. As a counterpart to that, what the Treasury proposes is to eliminate the distinction in tax rates between capital gains and ordinary income. Now, most people in the financial community are very much, and have been very much in favor of indexing capital gains and eliminating the inflation component of capital gains from the tax base. But they're dead set against treating capital gains as ordinary income, see. And this is an area which will have to be watched very carefully. I think you will find that many groups in the business community are perfectly willing to accept parts of the plan which will benefit them, but those that they believe will hurt them, they're against. Now, I don't think that, I think the tax system would be better off if we had one tax rate on all real income. And this is the objective neutrality that John talked about. The difficulty is that we're accustomed in our society to have differential rates on all sorts of incomes. Tax-exempt securities are taxed at 0 rates, capital gains at a maximum of 20%, and interest and dividends at a maximum of 50%. It's going to be awfully difficult to persuade everybody to accept one tax rate on real income.
But if you could do that politically, you would be in favor of it.
Oh, indeed. I think it would be a great improvement, not only in equity and efficiency, but also in simplicity. I am told by the tax lawyers that roughly a third or a half the tax code will simply disappear if we eliminated the distinction between capital gains and ordinary income.
Well, let's go back to the personal income tax side for a minute in terms of what Treasury is proposing. As part of the base broadening that they have suggested, they want to eliminate some items that many taxpayers deduct each year, including state and local taxes. There's some argument that the states are in good financial shape, that they are in better financial shape perhaps than the federal government. Why should we, at the federal level, subsidize the states by allowing them to have taxes higher than they would be, or taxes that would have a greater burden for the payer if they couldn't deduct them from their federal income tax? Is that fair, if you will, to state and local governments? Never mind fairness among taxpayers. Mr. Makin?
Well, of course, it's totally unfair in the sense that any major change in the tax code is unfair to those who have adapted to it. The state and local governments, in some, particularly in high tax states, have been able to raise taxes because they know that their constituents can deduct them from federal income tax. You've got to remember that any fundamental tax reform when you cut into it, is unfair. I mean, the tax code was written, all these provisions were put into place in Congress. There are tax expenditures totaling close to $350 billion in fiscal 85. That is, the special provisions in the tax code are giving away that much to individuals and corporations. So, no, it's not fair, but you won't have a neutral tax system. You won't be able to lower rates unless you broaden the base, unless you do it. You're going to have to get some new revenue somewhere, and it's going to have to come from areas like the deductibility of state and local taxes, taxation of some fringe benefits. Just to liven things up a bit, in my opinion, it ought to come from the mortgage deductibility for homeowners.
Well, John is entirely right. A correct individual income tax or personal income tax would tax all income and would provide deductions only, in my view, that are needed to sort of equalize ability to pay or to measure ability to pay out of particular incomes. And I think the only kind of expenditures that impair ability to pay in this sense are unusual medical expenses and casualty losses. That is, if two people each have $25,000 of income and one has a $10,000 medical expense, clearly the second does not have ability to pay on $25,000. And the tax law now provides a perfectly sensible method of distinguishing between extraordinary or unusual medical expenses and ordinary medical expenses. It says that expenses in excess of 5% are unusual. Well, that provision would be kept by the Treasury proposal. The law also allows a deduction for casualty losses in excess of 10% of income. That would be kept. In my view, I would sweep away every other deduction in the tax law, including the deduction for mortgage interest, because the mortgage interest deduction is a deduction that subsidizes homeowners. And in the interest of fairness and neutrality, I think that we shouldn't subsidize particular people. It is true that we may get somewhat less home ownership if we don't subsidize home ownership through the tax system. But we already have two-thirds of our families owning their own homes, probably the highest or close to the highest in the world. And I'm not sure that our society would gain a great deal if that fraction went up to 70%, or would lose a great deal if that fraction went down to 60%. But the important purpose is, as John pointed out, if you eliminate all the other deductions which are unnecessary, you could reduce the marginal tax rates even more than the Treasury does. The Treasury retains the mortgage interest deduction in addition to eliminating the deduction for state and local taxes. If the Treasury went whole hog in the direction of neutrality, the tax base could be broadened even more, and the tax rates could be lowered below a maximum of 35%, which I think would be all to the good. Unfortunately, the President and the Congress agree that it would be political suicide to try to do something about the mortgage interest deduction.
Well, again, in raising the question of fairness, when you have a provision that has been in the tax law for a long time and would change something that affects a great many taxpayers, some real estate groups have argued that if you were to limit the deduction, in fact, they have argued that even lowering the rates, which has the effect of reducing the value of any deduction, since a smaller portion of it can be offset against your taxes, they've argued that this will result in a substantial capital loss to the individual homeowner, that the value of his home on the market will go down because if he were to sell it to somebody, that new buyer would not be able to offset so much of the cost of owning that home against his taxes. Again, question of fairness here. Is this a situation where you have so many people having made this kind of fundamental investment that it would not be fair to change it?
Well, I think that all that suggests is that we have to look at each of these provisions to see how, quote, unfair they are, and to the extent that they're unfair, we have to have transition rules to moderate the impact. In the case of home ownership, for example, if you want to eliminate the mortgage interest deduction, I wouldn't do it right away. I would do it over a period of 10 years, for example, so that the impact would not be felt immediately. But I think that that with respect to many of the other deductions and preferences, I'm rather unsympathetic to the idea that you need transition provisions for fairness purposes. I don't think the roof would cave in if we eliminated the deduction for state and local taxes tomorrow. It's true that people in high tax states would pay relatively more tax than they do today, and people with low tax would pay relatively less tax. The Treasury plan takes care of that by reducing individual income taxes across the board by about 8%, and my guess is that the average taxpayer in practically every state would either come out about the same or would have lower taxes than he pays today, even with the elimination of the deductibility feature.
Mr. Makin, there's another group that has been complaining rather bitterly about part of the Treasury tax plan, and those are educational, charitable groups, nonprofit organizations that are unhappy that, again, the tax value, if you will, of contributions to organizations such as those would be less. They assume that the total contributions they get would go down. That provision is in the law to subsidize those groups. Do you think that those groups, in fact, would suffer if this plan were put into effect?
Well, let me just say that the plan would operate in two directions. The plan lowers marginal tax rates, presumably improves the functioning of the system, so the pie gets bigger. The incentive to give money to a charitable, currently defined charitable institution becomes smaller because you don't get to deduct it from your tax except for gifts of over 2% of adjusted gross income. Frankly, if asked, would you be willing to give up the provisions for charitable donations in exchange for adoption of the Treasury plan, my answer would be yes. And I don't think that most institutions that rely on the deduction would be that much worse off. Because I think that, first of all, is the question of why do people support institutions? One has to be a little bit cynical to think that it's purely for tax reasons. The other issue is how much of a change does the Treasury plan really put into effect for both corporations and individuals? For corporations, I can envision a situation where corporations would create foundations, and every 5 years they would give a big lump of a big donation to the foundation, and thereby get most of the currently favorable tax treatment that's contained in the Treasury proposal. So the Treasury proposal does not eliminate the deduction for charitable giving for corporations and individuals. It somewhat reduces it for small contributions. But here again, I think that the effects on overall ability to give would tend to cancel out the incentives to give that are in the current tax code. So,
you mean an extrapolating that to the individual circumstance? In other words, we're going to give 2% of your adjusted gross income to all charities and other such groups. You could refrain from giving anything 1 year, and next year give 4% and still deduct half of that.
That's right.
Mm-hmm. That's right.
In other words, you just give every other year instead of every year.
There you are.
Let me say that this occurs because the Treasury tried to do what I thought was the right thing in this connection, to provide a deduction for unusual contributions, not for the ordinary contribution. And it turns out that the average taxpayer contributes slightly less than 2% of his or her income to charities. What the Treasury proposal would do would be to permit deductions for the amount in excess of 2%. Now, there will be some taxpayers, and the tax books by J.K. Lasser and others will point out that if you double up one year and not the other, you will get an extra deduction. My guess is that this will be minor. The fact of the matter is that, as John pointed out, simply the reduction in the marginal tax rates, in effect, increases the price of giving. For a person who's now in the 50% bracket, the price of giving is 50 cents on the dollar. And if you cut the marginal tax rate from 50 to 35%, it increases the price of giving from 50 cents to 65 cents. That's an increase of 30%. Economists will differ on what effect that will have on charitable giving. Let us assume it does reduce the incentive to give. John pointed out the increase in disposable income will make people feel wealthier and would offset this effect. I think that the charge that the particular way in which the Treasury Department gains revenue in this area will hurt the charitable contribution, the organizations benefiting from charitable contributions, is not fair. Most of the damage would be done by simply by the reduction in the marginal tax rates. My own view is that the 2% floor will not discourage too many people from giving additional funds to charity.
Let me ask a more fundamental question about the Treasury proposals. This is just the overview. There's a second volume that lays out the details of the proposals, and it turns out on close examination that some features, such as the treatment of interest deductions, even are not fully spelled out in that second fat volume. Some of them are so complicated that Treasury hasn't gotten around to putting down on paper exactly what they think should happen. Mr. Makin, do we have something here that will deal with simplicity, or do we have another set of changes that will leave the tax law every bit as complicated as it is right now?
I think on the simplicity issue you have to divide it into two parts. The transition from the current system to a neutral system will not be simple, simply because the current system is so convoluted and so far away from neutrality that there will be an awful lot of adjustment involved. The system that we would ultimately get to under the Treasury proposal, I think would be a bit more simple, but I wouldn't want to try to sell the Treasury proposal on its simplicity provisions. The main culprit with it, of course, is its attempt to be economically correct with an income tax base. That is, it wants to make sure that you tax real interest, that is, the interest that doesn't reflect inflation, real capital gains. It wants to be sure that you're able to deduct real depreciation instead of nominal. All of these provisions mean that if the rate of inflation goes up or varies around a lot, you have to do an awful lot of adjusting of what the dollar numbers say. Gets you into a very what seems like a complicated area. In principle, it's simple, but in practice, yes, it can be complicated. As the accounting profession has discovered, the basic accounting practice is not designed for an atmosphere of high and volatile inflation rates, because it becomes very difficult to do your measurement. Same problem with the tax code. So bottom line is, to deal with the problems of measuring real income and real cost, the Treasury proposal has to do a lot of indexing. It will be fairly simple if we get inflation down to a low level and it stays there, because then the difference between real and dollar numbers isn't very great. One of the reasons that the Treasury proposal deals with inflation so extensively is that we found that in the 70s and early 80s, when inflation picked up, this created tremendous unanticipated distortions in the tax system. So if we go to low and stable inflation rates, this system won't be quite as complicated. If we go into an era, we adopt the Treasury proposal, we have high and volatile inflation rates, it'll be fairly complicated.
Well, can I add one point to that? I think you have to distinguish between the impact on simplicity for the typical individual taxpayer as compared to businesses. I think John addressed himself mainly to the business taxpayer. For the average taxpayer, this would increase the simplicity of the tax system. Most taxpayers have very few, if any, capital gains, which would be affected by the indexation provision. Very few taxpayers have large amounts of interest and dividends. The typical taxpayer reports wages and salaries, and that's about all. For the typical taxpayer, this would be a vast simplification. I think that it will turn out that if this were adopted, about 3/4 of all taxpayers would not itemize any deductions at all. This would be an increase from 2/3 today. And what's more, these 3/4 of the taxpayers would not have to worry they're being shortchanged by the fact that they're overlooking some deduction that they're not aware of right now. So for the average taxpayer, this is a terrific simplification, and I think that's what the average taxpayer wants. Now, with respect to business enterprises, if you want to tax real income, and I hope that we get our inflation rate down to the point where people would agree that it isn't necessary to index the tax system anymore. If you want to tax real income, then that is a complication that businessmen and investors will have to go through to calculate their tax base. But I think they have the technical capacity to do that. The major point is that for the typical taxpayer, there will be simplification.
Well, would it remain? If you look in the history of tax bills for the last dozen years, it seems like every tax bill, and we've had one almost every year, major ones at 3-year intervals or something of that sort, each one has attempted to address and close some loophole that suddenly became important. Suddenly everybody agreed, my gosh, that's awful. We've got to do something about it. And the question has been whether the lawmakers have been able to keep up with the inventiveness of the tax lawyers. The tax lawyers seem to find loopholes faster than Congress can close them. Would that happen this time around, do you think? Suppose you put the Treasury plan into effect, would there still be the same incentive, and do you think there would be the same success to go looking for loopholes, new ones that somehow we still overlooked?
Well, if the Treasury tax plan were affected, you would be unwinding 30 years of congressional history since the 50s, which has been kind of progressively taking up things one thing at a time and saying, isn't this a good thing? Shouldn't we allow a deduction for charitable giving? Shouldn't we allow a deduction for state and local taxes? Taken separately, all these things seem like a good idea. Why are we talking about tax reform now? One of the reasons is that when you add them all up, they create this thing we now call the tax code, which a lot of people have decided, and I think with good reason, is a mess. So that if the Treasury tax plan were passed, there would be a great deal of activity and need to adjust to the change. But if it were passed, it's essentially, fundamental tax reform is essentially moving toward a tax code that once enacted doesn't need constant tinkering. And that doesn't guarantee that Congress would leave it alone, but the incentive to tinker would be less. I think, one of the problems with the Treasury proposal, to return to an earlier theme, is it does leave one loophole through which you can drive a truck, and that is deductibility of mortgage interest for the principal residence. If the Treasury plan were adopted, I would go and attempt to buy an office building and get it called my principal residence, because that's the only way that I would be able to deduct all of the interest expense for a highly levered investment. So even the Treasury plan isn't pure, and that's a $30 or $40 billion a year item. But to answer your question in its original form, if a plan of this type were adopted, the message that Congress would be sending would be essentially that they're going to do less doctoring, less fooling around with the tax code, and there would be less in the way of loopholes.
Well, also, I think it's important to note that the Treasury plan hangs together, and except for the mortgage interest loophole that would remain, the Treasury plan would eliminate practically all tax preferences. If you modified the Treasury plan in a number of respects and permitted some tax preferences and eliminated others, then I think that in a very few years we'd have the same sort of code we have today. On the other hand, if we wipe the slate clean and taxed all income with very few deductions and no tax preferences, then the Treasury Department and the Ways and Means Committee, the Finance Committee would be able to withstand the pressures for introducing new preferences in the tax law, because they could say, look, in 1985 or 86 we eliminated all of these in the interest of simplicity, and if we give you this one particular tax benefit, it'll open the door for others. I think the idea is to do it in one fell swoop. If you do it gradually, or what is called in the jargon incrementally, you're not likely to succeed, because some taxpayers would say, well, if you're retaining somebody else's loophole, mine is at least as important or more important than the other guy.
Yeah, let me just add to that for a minute, because I see a tendency developing within the administration when they talk about tax reform. It's sort of the, if you like it, we'll give it back, and if you don't, we'll keep it out approach. That is, the President and the Secretary of the Treasury talk as if, well, folks seem to like accelerated cost recovery, so we'll put that back in, and some people don't like the way we're treating capital gains, so we'll take care of that. With a proposal that's as fundamental as this, you can't do that. I mean, simply on a revenue neutral basis, you lose so much. If you give somebody something back, you're going to lose a lot of revenue, so it's no longer revenue neutral. So that by the President, in a way, has perhaps trapped himself a little bit by insisting that the proposal be revenue neutral. It doesn't mean then that you can say, if you don't like it, we'll take it out. This thing rather, well, it hangs together. And so it's not just a matter of saying we'll take the parts we like and we won't take the parts we don't like. And as Joe says, if you really back away and say, well, we'll get a tax bill this year, like we've had a tax bill for every other year, business as usual, then it's really counterproductive. It's just another round in uncertain and arbitrary changes in the tax system that's basically a waste of time for everybody but tax specialists who profit from trying to advise people how to game the new system.
Well, one other loophole, if you will, tax preference, whatever you want to call it, that Treasury leaves alone is saving for retirement. They will let businesses continue to count as a business expense and therefore a deduction, cost of contributing to a pension plan for their employees. It continues to allow individuals to put $2,000 into an individual retirement arrangement each year and deduct that. It doesn't touch the special plans that self-employed individuals have, the KEO plans and so forth. Why were those left alone? Should those be eliminated too? You said you would take away mortgage interest deduction for principal residences. What about saving for retirement?
Well, I think that that's one of the major problems with the Treasury plan. It's quite inconsistent. It says that we ought to tax income, and as you point out, the savings that are set aside for retirement, either through employer plans or through IRAs, are just as much income as other interest and dividends, for example. The problem is that I think the Treasury Department did not want to take on the battle of taxing employer contributions to private pension plans. My own view is that that's a battle worth taking on, and since I'm in favor of income taxation, I think we ought to tax all income, including employer contributions. But in addition to all of that, what the Treasury did was compound an evil in present law that I think was unnecessary. Right now, we allow deductions for IRAs, individual retirement accounts, not only for people who are not covered by private pension plans, but that was the original justification of IRAs. There are a lot of people who work for employers that haven't set up their own plans. And I think there was some measure of justification for putting in such a provision. But in 1981, the Congress I think that the Congress did it unilaterally. I don't think the administration proposed it, but it certainly approved it. The Congress allowed IRA deductions for anybody up to $2,000 each year. And what's happened is that people have simply shifted money from some accumulated assets and into accounts called IRAs. They didn't do any extra saving, and we've lost an enormous amount of revenue. The present estimate is that we will have lost by 1986 about $13 billion of revenue. The Treasury goes even further, increases the deduction for IRAs from $2,000 to $2,500, and also permits spouses who aren't working to deduct as much as $2,500 for IRAs. So I think that in this respect, the Treasury has really departed from its principle of fairness and evenness, and I think that at least the IRA portion of the Treasury proposal should be eliminated, and that would permit a modest reduction in the tax rates.
We have just a few minutes left. We've talked a great deal about some of the economic effects of this proposal. We haven't spent a whole lot of time talking about the politics, except indirectly in items such as deductibility of mortgage interest. Put on your political hats for a moment, if you will. We have the Treasury proposal, we have the two congressional proposals that I mentioned from the Democrats and the Republicans, actually some others as well up there on Capitol Hill. What do you think are the political prospects that one of these, some amalgam of them, will pass in the next year or two and would actually move us in the direction of a more fair, a more neutral, more simple plan, whatever word you want to use? Mr. Makin?
I think the chances are quite remote, frankly, largely because this year the big issue that seems to be occupying everyone's attention is the deficit. I don't think that's a valid argument. I think it would be perfectly possible to move ahead on tax reform and deficits at the same time. But I just see the resistance to this plan that's building. I see the President and the Secretary of the Treasury, Baker, backing away from the plan as it's written. And I see this plan as something that either has to hang together and go ahead with the support of the administration, or you have to go back and design a whole new plan. This isn't something that's going to take very well to the idea of very small changes here, very small changes there. So as a pragmatist, I see very little chance of fundamental tax reform, partly because of the difficulty of keeping the plan together, partly because of the normal way that Congress does business.
I think that the basic problem is that all of the lobbyists and all of the interest groups that have been, whose loopholes and preferences will be removed have already descended on Washington and are pressuring the administration and the Congress to dilute the plan. Unless all of the loopholes are eliminated, as I indicated earlier, it's not going to be easy to do this. And the only way Congress is going to react is if the average taxpayer makes his views known to the Congress. Fact of the matter is that 80% of the people would be better off under this plan, and there's some way we have to galvanize the opinion of the average taxpayer in favor of tax reform.
Thank you both very much, John Makin of the American Enterprise Institute, Joe Pechman of Brookings Institution, for being with us to discuss issues of tax reform. Thank you.
I'm going to ask those of you who are here watching to stay for a few minutes.